Three, two, one. Good afternoon. This is Matt Slonaker with Growth in Action. And today I'm pleased to have someone I consider a friend, as well as an industry thought leader. Most of us, obviously, on LinkedIn, have heard KP's thought leadership on a day-to-day basis. And he's also an avid golfer, in case you didn't know that. So I'm pleased to have KP with me today. And so, KP, we've got some questions here. We've got about 30 minutes. We're going to touch on some key emerging things to focus on in 2025. But why don't you go through a little bit of just a brief intro of what you see coming into 2025 as far as just maybe lay the landscape. And I've got some of the assumptions up here to maybe assist you as well. So I'll give you the floor.
Well, I enjoy our time together. We always get together and grab dinner and have a cigar, play around the golf, and all the way back to the San Diego IMB at Aviara. So it's been a great friendship. So appreciate you having me on here. We've had all these conferences this year, and I felt like the mood and the energy kept rising as rates went down. And then the Fed cut the rate 50 basis points in September, a little later than most thought, but a bigger first cut than most thought. And so what happened, rates, kind of spiked up, and some of the energy got sucked out of the room because, the last half of the year is usually kind of a grind. It's a little tougher. We're Paramount Residential Mortgage Group. We're independently owned. There's four of us, the two founders, Paul Rozo and Robert Holliday, and then myself. I've been with the company over 14 years. And as a partner, about 9, and then Gary Malice, who runs our cap markets and strategy, is our partner as well. We feel like we have a nice balanced approach because we have retail, wholesale, and correspondent, and so they kind of as there's a little bit of a balanced portfolio, if you will, right? So it's and we all are also servicing some of our production. So the second half of the year hasn't been as bad for us, and feeling that energy kind of match what interest rates do, in these last couple shows going into the cold part of the year, we're 2 weeks away from the winter solstice. It's interesting because I feel like we're in a good spot. And next year, I think everyone believes we're going to be in a great spot as an industry, rising volume, rising projections, more purchase business, and then all the buzz about AI, right? And we've been talking about AI for a little over 2 years. I know it's some of your topics we want to talk about today, but it was a big talking point, and it's here. It's game changing. As I drove my 5.5-year-old Tesla, that's all AI, full self-driving. It drove me to work while I, knocked out calls and read emails. So I'm pretty excited for 2025 and can't wait to do this roadmap with you.
I was going to say, I appreciate that. And it's interesting, the whole AI, we're definitely going to dive into that. So maybe that's a good kind of place. And besides AI, we'll just kind of talk about digital transformation as a whole. So when you look at maybe some of the competitors that you compete with, as well as what you're doing inside your own team, how do you foresee digital transformation next year? Are there 3 or 4 key themes that you can touch on?
Yeah, I'd say the biggest one is, let's set the table a bit. Cost per production for a loan, all in, depending on what study you read, $12,000, $13,000 a loan, whatever it is. Like the bulk of that is from sales, commission, override, sales management. A lot of it, right? And so if there's a way to get that cost down, not by eliminating salespeople, but by getting more throughput, right?
Yes.
So the AI assistance that is working in sales, I think is at the top of everyone's roadmap. I've been doing demos like crazy. I've already done 2 demos today. I did one earlier this week on Monday, and had a couple a few weeks ago. The wagons are circling. It is happening now. And so where I would say those 2 AI pieces go is you've got one that maybe requires a little more maybe integration with your LOS or point of sale is a fulfillment AI assistant. So this will help you gather a more complete loan more quickly. Catch some things that maybe the originator, processor, or loan officer assistant missed, or heaven forbid, sometimes underwriters miss it, and it's a very costly mistake. So having cleaner files and things caught by AI within seconds and buttoning things up, not necessarily consumer facing yet. I like Friday Harbor. That's one I've seen out there. And there's a whole bunch of them. I'm sure you have a whole list of them. So that basically helps us. And so I don't need to be customer facing yet, but it does help get the file better. So that digital transformation of cleaning up the sales process is huge. And then the other piece is the actual selling. So I saw a demo of one on Monday where literally this AI assistant calls your borrowers, and it is having a conversation. And I listen to demos, and it's incredible. I mean, so it's setting appointments, it's taking some information, public information. It's not doing unlicensed activity. It's not talking rate, products, asking for social security number. It's just okay, no worries. Let me help gather some information so we can see what kind of buying power you have. Okay. And then they start to go through it, and then it sets the appointment on the calendar and has this, mostly completed app or even short form, whatever you program it to do. And the LO comes into work, and there it is on the calendar when to, call Matt to follow up and finish the deal. I mean, it's amazing. I mean, literally, we're listening to it, have a conversation with real people, and then you can go back and train it. So I put the AI on the sales side right there. And those are huge. I mean, those two things are huge to help us do more. Our top producers are going to embrace this stuff and scale and do a fantastic job. And ultimately, we'll be able to help get, that cost reduction on the sales side down a little bit.
What about, are you measuring that too, as far as like an improved sales conversion rate? Is that one of the expectations of this for you next year, is how will it improve our conversion rates?
Yes. So in the demo of the sales voice bot, if you will, by the way, they don't want to say bots, we'll say AI assistant, whatever. That is, it is better at converting than what their math is than anyone except the top 1% of loan officers today. And I actually watched it, right? So Jessie, the female voice, is speaking to an older lady, and the older lady says, I've been getting a lot of calls from you people and all your mailers, and just give me your information and I'll just call you when I'm ready in a month. And before she's even done speaking, okay, the female AI assistant talks over another female, which we know you cannot talk over one. Okay, like no, if you're a man, but this is a female bot voice over talks this elderly lady. Okay, no worries. I understand your hesitation, but when you're ready to go next month, if your buying power, you will be in a much better position to get what you want in the time frame that you want. So can I go ahead and get some piece of information for you? And there's a little pause, and everyone in the room is kind of like, and the lady's like, okay, that's fine. Now, I would venture to say 7 out of 10 salespeople, when that lady, out of respect, for the elderly lady, which is, I'm not ready. Just let me get your information. I'll call you back. They'd be like, okay, all right, here's my name and number, and call me back. And this voice bot, Jessie, just talked right on through it and overcame the objection. It was incredible. Now, of course, they cherry pick, what they're showing us. I don't know how many times that worked, but it was really cool to see it, like literally a bot talking to a human in a live conversation, and the person didn't even know. And so then, of course, I know our compliance people, they're like, okay, well, when does it have to say it's an AI? What's the line drawn on taking an app? Like, we'll get into all that. We'll figure all that out. And, certain states like in California, you have to say whether you're an AI assistant, right up front. And so we'll clean all that up. But the use case is here. It's real. And I mean, imagine all the time back, right? Like, let's do no conversion math at all. Okay, one of the scripts was a 13 and a half minute, I'll call it a therapy session with a lady who lives in Palm Springs,
Yeah.
And look, we've all been in sales. We know how it is,
Yeah.
it's what it is. It's part of it, right? She's talking about her 2 dogs and the restaurant she works at and her house. And it's a mess. And, she's barely hanging on, And so, Jesse, the bot, the AI assistant is like, yeah, you understand there's some life struggles and, we want to help you and help, help you with your buying power and give you, so kind of went down the script. That's 13 and a half minutes, which could have been 20 or 25, depending on which LO is talking to the lady, that is now back. Okay. It was done by an AI assistant that made the call, had the conversation, transcribed the whole thing. Then you can highlight the conversation and go, I don't like the way you answer it. Think about answering it like this, and you type it in and it learns. And so, in the time it took to read the script and then put in the line to retrain the bot, it didn't take 13 and a half minutes. And so it's just about time for me. It's about compressing time. And time is money, right? And so getting the conversion is even a bonus, right? Because you got the time already.
Yeah. Yeah. I think while we're talking about that, Nan, so as you look at AI and the tech, and I know that you and your team are out there kind of in a leadership quadrant with doing that. What are some of the people things that you guys have to address as a leadership team around this? Because I'm sure what I see typically, KP, is the change management aspect of this typically gets lost in doing some of these pilots and initiatives. And this, there's even at a leadership level, some people that maybe want to see this stuff not work. So how are you guys looking at the people? How are you helping the people, the change? How are you guys addressing that? What are some key lessons learned there?
Yeah. I mean, it's like DU is supposed to replace underwriters, and they're the most expensive they've ever been, right? And that's not a knock on them. They're obviously worth it. But the point is, we've seen this, the appraisers, the prices keep going up for appraisals, and so we've seen tech come in and supposedly, it's less than feared, right? It's oh, man, we're going to automate out of existence. And so I'll zoom back even further. I signed our first Salesforce contract about 8 years ago. And then I was invited to the Presidio, the inn at the Presidio there under the Golden Gate Bridge. Front row, sitting, watching the Wired magazine editor and Mark Benioff, the CEO of Salesforce, talk. And they were talking about automation in the workforce. And at that moment, okay, and at the end of 2016, I think it might have even been January 2017, 45% of the world's job can be automated today with existing technology. That was what, so the question was, when 45% of the world's jobs get automated, how will you as a leader, a transformational leader, transition and repurpose your people into other roles in the company? And so that's always stuck with me. And as an owner, that's a good thing for PRMG employees, because we don't want to automate people out of their jobs. We want them to do more with the job they're doing. And so these AI tools will help us scale. And once we hyperscale as a company, I mean, you're going to have haves and have-nots in this business, in the industry. And so there's certainly an arms race going on for adopting tech tools and AI. And it's not just a buzzword that we heard starting 2 years ago once ChatGPT hit the scene and, call it February of 22.
Yeah.
I mean, it's real. I mean, I've seen the tech. They've been working on it. They've been building it. They've been raising money, and it's here. And so I just, we have to be mindful about training our people internally how to use the new tech so they can do more at their job. And that's a process, but it's so intuitive. Like you don't take training when you get your Samsung. When I get my Android phone, it all just makes sense. You notice I purposely didn't say iPhone because everyone's a hater when you're on an Android. So, but the stock is at an all-time high at Apple. So I'm not a financial advisor. I'm not responsible for your losses, only your profits. But if the tech is intuitive, like the smartphone, the training is intuitive. The training is inherent. It's, oh yeah, this makes sense. And so you're not training someone like I need to go to this field and that, label it this, and go to this data point and then field it and label it. So there's a quicker lift. And I will say that a lot of these tech companies I'm looking at are really building some really intuitive UI and UX.
Yeah, and I think that my advice as I kind of work with some different players is focus initially out of that C-suite and the next level down, leadership level. So there's courses out there. I took one last year through Berkeley Haas on advanced AI and business applications. And so those are the types of things, a month to 2 months, maybe 4 hours a week, right? Not that much that your executive team kind of do those types of things together. And it really helps get the leadership level solidified on the game changing that the tech can play in the business. And really, truly, I think one of the things our industry doesn't do a great enough job compared to manufacturing and healthcare and some of the other industries is the R&D side. So I get it. Budgets are still tight. Profitability, while it's improving, to your point, it's obviously not something that we're sitting here back in 21 levels. And so I think if you're able to invest, say, even 4 or 5% of the revenue in your training budget for the executive team and get them to go through these courses together and really get them to see the game-changing transformation, it's going to help them, say, 3-5 years down the road. So that's something that, again, you guys are a leader, and it's great to see your passion. I love it. I don't, KP, being candid with you, I don't typically see that passion with other C-suite leaders as much. So it's good to see your passion on this, and I can tell.
Hey, buddy, I mean, not a knock on my peers, but I'm only 48.
No, but regardless of the age, I just don't. I'm seeing, and we saw this when the rates dropped back in that September time period. How many job postings did you see reappear in LinkedIn? And like kind of cringing, like, oh no, here we go, get like stop with the hiring because you're going to just go back and do the layoffs again, right? Like, that's really focused on the hyper automation, the hyper intel pieces, and so it's good to hear that. Let's kind of switch regulatory, trigger leads, and what else are you seeing kind of coming to a forefront? And I get it, we have a new administration coming in, but anything that you're concerned about or that you're watching on the regulatory front?
Well, the trigger lead bill is probably the most important to, mortgage bankers across the board here, certainly the IMBs. And so the way the bill is written is that there are carve-outs if you are the servicer. So, it's a bill that a lot of people can get on board with. It was trying to be attached as a rider with the National Defense Authorization Act, and ultimately got pulled out here just recently. And I think some of that was due to the lobbying efforts by the credit regime. And it's absolutely a monopoly on the algorithm, and it's a shame because we're charging clients $240 for a credit report on their loan. And I mean, don't you know, like, so you can buy raw trade line data for like pennies. I mean, literally pennies. So like I could just see a trade line for all the lines of credit that a borrower has without putting a score to it or running it through an algorithm and giving more weight for this or that or the time served. Like I can just see what they've done in the last 2 years, and I can see if they've ever had, so like, for example, Fannie Mae and Freddie Mac, they don't pay $80 a report, for, an algorithm. They have raw data and they have their own modeling. Now, to both of their credit, they're not going to show the world their modeling for that cheap raw credit data that they use. But there are some states that are saying they have to. And there is some regulation about AI, because if data and modeling is used to give out credit, and the GSEs are still in conservatorship, not a private entity, I think the states may win that. And so what I would say, if Fannie and Freddie and Jenny are listening, is just go open source with with that credit line data and allow lenders to buy the really cheap data and run it through your modeling. Okay. Just run it through DUNLP without having to have a quote score on it. And obviously it's going to take a lot of structure in the cap markets, you know, selling mortgage-backed securities, but, you know, not having a score, right? You know, that is attached to it. And so I feel like there's a way to get it done. It's a longer runway to actually do it that way, but it's what the car business does. That's what credit cards do. And so, you know, those loans are collateralized, you know, in the private market, you know, PLS, right?
Yeah.
So we have a long, rich history of selling MBS in this business. And I mean, it's not because of the score of the borrower. You know what I mean?
Yeah.
So, you know, at the end of the day, like loans at default is because the borrower lost their job. It doesn't matter what your FICO score is, right? So I mean, you could look at default ratio, at least, you know, in conforming loan world, and it's almost always trending with the unemployment rate going up or down.
Yeah.
And so that's a longer structural thing to set up, but they're taking the time to structurally have a Vantage score now, and then a buy merge, and then which that may get unwound in this new administration with a new FHFA director potentially, which I don't know. I mean, maybe I'm a little bit, you know, off my rocker here on 1211, but I don't think there's been an FHFA director chosen yet. I love Dr. Thompson. I would love for her to keep going. You know, she's been there a long time and great. I do know that the CFPB director has not been named, and you got, you know, Elon Musk openly saying delete it, you know, and so I don't know what's going to happen there. I think, you know, we should be maybe a little more, you know, cautious and less glib, you know, on respect to the CFPB, because there are some rulings and some things that they do that are favorable. I mean, they just handed $1.8 billion back to consumers who got defrauded by a credit repair company.
Yeah.
So so it's not, you know, not everything that these regulators do is a problem. They're, you know, and so we'll see. I mean, you know, we have you know, about 5 weeks before, you know, new administration takes place, and they get like their 90-day grace period where they're trying to get their footing, and then we'll see where housing policy rolls from there.
Yeah. Well, let's come to kind of a closure on this. We're coming up on the 30-minute mark, and so what would be, you know, I always like to leave listeners with a call to action. So maybe break this out by level. So the C-suite where you're sitting versus sales, loan officers, people that you lead. So if you're kind of separating them, what are 2 or 3 key things that you would say they need to start acting on for next year?
Well, I think investing in technology, like if you didn't do it the last couple of years, you know, you're not late to the game. You know, now if you start taking a look, well, a lot of the tech partners are better than they were even 6 months ago. So I would say continue to invest in technology and your people using the technology. And I think that will be the game changer for the C-suite. But you got to spend some money, and you got to have, you know, and I put it out there on my podcast on LinkedIn. You know, I'm out there on LinkedIn, you know, pretty much every Monday and Thursday. Sometimes I wait till Friday if like there's a jobs report or PC or something important. But you know, I talk a lot openly about what owners are looking for, what the C-suite is looking for from my perspective. And I don't think my views are too dissimilar maybe from other peers of mine, except that I'm on the road 82 nights, you know, beating the streets trying to find all the stuff. And so, you know, it's not too late to invest. I still think non-QM has got some really good runway. The only like to steal, you know, Stan Mendelman's book title name, Sitting Around Corners, you know, the only thing I could see that would be disruptive to non-QM market is if Fannie or Freddie decide to do bank statement income loans. They haven't said that. They haven't, but I mean, I certainly am advocating for it. You know, I mean, you get 12 or 24 months of look at raw bank data. So 45% of the non-QM market is a bank statement loan at that product. And so if that comes into the Fannie Freddie bucket, it'll cast a wider net, be more automated, more streamlined, and be a better rate for the borrower, by the way. So I would love to see that happen. And so if you're out there, purchase business cultivating, non-QM is huge. And I think will continue to grow along with the purchase business growing up to 1.47 trillion, 1.5 trillion next year and 2.1 trillion plus all in next year. And equity lending is huge.
I was going to say, you see HELOC still going. And part of that, I think, is based off that credit data that we're seeing with people still taking out credit. And then you're also seeing on the negative side delinquencies. And so I agree with you. If they're sitting on equity in the house, right, that's going to be there. So any other key products, anything on like out in California, it's escaping me, KP. What's the separate dwellings?
The ADUs. Yeah, ADUs. Yeah. Yeah, the accessory dwelling units.
Yep.
Yeah.
You see that as an emerging product as well with affordability and housing. Yeah.
Yeah. I mean, California, for all of its flaws as a state and being completely business unfriendly, and I mean, just trust me, like it's tough here. The taxing, the lawsuits, all the stuff, right? They did a great job of really pushing forward, ADUs, the accessory dwelling units. And it is a good home affordability option. And so I talk openly on my LinkedIn about, my side hustle doing some ground up construction projects, and we put an ADU on every one, and sometimes two. So, if we're building a house in Culver City where it's already expensive, we're converting a 4-unit into a 6-unit by redoing the 4 and then putting 2 ADUs in the back because it's a big lot, and that way we can get the prices down for rent. And it is very helpful. The California legislator, I'm on the board of directors for California MBA, and we were up in Sacramento last year and this year, and I'm going again next year. And they're really worried about like bad actors in the ADU space ripping people off. And so there's been like this kind of lingering potential legislation within our state, as far as like requirements on who can sell and that kind of stuff. So it hadn't happened yet, but they are concerned about that. And so, you meet someone and they're like, yeah, I'll build you an ADU, here's what I built, and then give me a $20,000 deposit, and then they take off the money, so that's kind of the fear of our state legislature. But yeah, I mean, FHA, HUD, they've done a great job of having ADUs as part of their guidelines, Fannie Freddie. So I really do feel like, that's probably a little bit more realistic for affordable housing tackling, as opposed to hoping and praying, when 3D printed homes will come around, or how many tiny homes at scale, the big builders can build, which they're working on. Got to give them a lot of credit.
Yeah.
But it just takes time, and we're still woefully undersupplied, which is having home prices go up, insurance costs going up, taxes are going up. At least rates are going down. So that's a good thing.
Well, any final words to the loan officer community out there, especially those that work third party and wholesale? Any closing advice that you'd have for them?
Yeah, I mean, we're built by originators for originators over here, and we have 3 channels: retail, wholesale, and correspondent. They're all grinding. We're all grinding. We're trying to find ways to get more purchase business. I would say, in addition to, working on your non-QM business to help, reduce fallout and give more options for your consumers and borrowers, I would try and adopt, just constantly adopt a new piece of technology into your system. Don't put it off. Don't wait. We're so structured here as a company. We have all this support, and we have best in class tech, and some tech that you can only get as an enterprise, retail organization. But then I'm also, I was a wholesale AE when I started this business. So I oversee our TPO channels as well. And, everyone's busy, right? And so I see, it's hard for like, a broker shop, to just like, all right, I'm going to go work on my CRM, or I'm going to go work on my new digital app. You just got to do it. You got to adopt one piece of tech and then once you get good at it, then go to the next one. You can do it, it's your New Year's resolution, right? So, we're not going to stop going to the gym, February, 1st, we're going to see this thing through all the way through next year. So, keep on adopting new stuff and iterating your business, because technology is changing incredibly fast around our world right now.
Yeah, and I think it's going to continue to accelerate. So I was on with an investment bank that was looking at making, we didn't even touch on this, so maybe another topic is BPO, BPM. And they were looking at a debt investment in a BPM player. And so they were really, since it was debt, not equity, they were really more concerned about the risk side. And especially in this case, this company had 30-40% of their revenue coming from mortgage. So hence why they were interviewing me and talking with me today. So I think the whole BPM and what I was really reinforcing is the same thing you were doing from a lender perspective. I'm reinforcing the same on the BPM side. I'm still not seeing enough of them take the true lead of bringing in hyper automation and bringing in AI and really working themselves out of these seat positions that they have in many of these large enterprises. The pricing needs to change to true value-based pricing, or at least variable. Get away from this fixed headcount, FTE. So if you're a BPM player and you're out there, love to have a conversation with you, separate podcasts. And, Kevin, I think you have one or two players that you work with on BPM as well, correct?
Yeah, we're pretty much just down to one, with one as a backup. And so, it's helped us scale, right? And so we're on Compass, and we can't have more than one person in a file. But supposedly that's going to change pretty soon here. And when they go to their next gen platform, internet based, multiple users in there, then a lot of us mortgage bankers that are on Encompass, we're going to finally be able to have that assembly line. And we've been kind of sort of shortcutting that by going offshore and using fulfillment teams, which is great, but to break those jobs down even further will I think be a huge cost savings, and will work for profitability and pricing, and will be
Are you seeing any solution providers adapting kind of a value-based pricing structure with you? So like in the case of AI, they come in and they say, we're going to improve your conversion rate by 10%, blah, 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 figure the savings based off your volume, right? What you're converting today. Are you seeing providers do that, or is it still more?
Yeah. So like for example, the one I mentioned earlier, Friday Harbor, they're doing success-based pricing. So, we can use them on our entire pipeline, and then when the loan funds, then you pay them a fee. And so
knowing if it's funding, it's performance, there's no upfront charges, no implementation. Good.
Yeah, which I love. I mean,
yeah,
that's how we prefer to do all of our contracts, because then there's revenue to offset the cost, and then it's just up to us to analyze, is the cost worth the benefit? And so if you can shorten the whole processing lifespan by even 5 days or 5 hours of a processor's work, or 2 hours, really, maybe even $100, a funding, it's just a couple hours of a processor working on a file. But then also the time you get back, plus, this loan isn't taking as long because, a couple people miss something along the way, and then it goes to underwriting, and then it comes back, it's a new condition, then you go back and then back. Like, you just shorten everything up. And so, you're locking for 15 days instead of 30, or whatever. Not paying for extensions and all that. And you don't have risk of the market floating around with the loan taking the traditional 42, 45 days that they take per every single survey I've ever seen. So those costs are immense saving, and you can offset the AI assistant with revenue. So that's huge. I mean, I think that, they listened to you. They took your advice.
Well, it's good to
at least someone did, right?
Yeah. I was going to say,
you're a wise man. I always learn. Every time I'm with you, I learn a lot.
Hey, this was great, KP, and I appreciate your time, big guy, and happy holidays from both Kevin and myself. We appreciate you guys. ping us both on LinkedIn. This will be shared on LinkedIn. You know how to get a hold of KP, Matt Slonaker, same thing. And again, happy holidays from both of us.
Cheers.
Thanks,
Thank you.
KP.
Thank you, brother.